in my report, I'm saying, I'm not a kind says already. Now I post.
Is that me?
I see it's okay, it's all next to me. Shall watch
and I maintain no one. It's a chocolate, no one is a maca. Alright, so standard tax planning measures. Now what we want to, yeah, it's already on. So everything is on. So standard tax planning measures has to do with, alright, how we can find ways and means in order for companies, individuals and entities to what? Pay tax to the government by what? Manage low tax property. So there are three key things, there are a number of things we're going to be looking at, but there are three key things we're going to be starting with. First, we're going to look at what is the tax planning. Second, we will look at tax evasion. Third, we will look at tax avoidance. And fourth, we will look at the various benefits or investment opportunities available and the tax breaks that are available for it. What is going to happen here is that the examiner is going to put you on the spot and somebody is going to say, the company is going to approach you. We want to undertake a project. What project do we undertake in order for us to reduce the tax payable to the government? So you're going to suggest to the person, you can invest this place, that place, this place, this place, this, and then provide them with a professional advice. You won't do? So let's go and take some definitions quickly. 3 to start with. Tax planning, tax avoidance, and tax evasion.
How many doing X?
Is that? Online, currently about 7 people. Then on campus, I think some people will be joining, maybe from next week. That's what they said. Next week. But online currently 7, and some people are also in the pipeline for that. So let's go. Tax planning. Tax planning. So what is tax planning? Let's take a definition. This entails organizing one's tax affairs, organizing one's tax affairs in such a way as to pay just what is due. Organizing one's tax affairs in such a way to pay just what is due. To pay just what is due. Now we will come back to that definition in a moment. Next one. Tax avoidance. Tax avoidance. This refers to the practice of using the loopholes in the tax laws, or stated benefits in the tax laws, to pay legitimately lower tax. So tax avoidance has to do with 2 things in general. One, it has to do with finding out, all right, what are the loopholes in the tax laws? What are the areas where the tax laws has a way that we can use? Then, what are some of the stated benefits in the tax laws that if you do A, you do B, you invest in A, invest in B? Recently, you know that the one district, one factory investors, they have been given tax break. That's been passed by Parliament. So all the income they will be earning on 1D, 1F, they won't pay tax. It's part of tax planning. So now if someone comes to you, where should I invest? one of the coolest investment they can do is to partner with the government under 1D, 1F. Because when they do that, boom, they are not going to be paying any tax on the income that they are earning. Is it? Okay, we don't have the details on that, but then the whole amount is exempted as far as the investment is there. So when you take out the investment and put it somewhere else, good. But then as far as it is there, you partner with the government, you're not going to be paying the dividends. So this one is a legitimate thing to pay low tax. And this is one of the key objectives of every company around the globe, finding out what are the loopholes in the tax laws, what are the benefits in the tax laws, so that we can legitimately pay what? Lower taxes. But let's look at the opposite aspect, tax evasion. Oh, it's your friend, eh? That's serious. Tax evasion. This refers to the practice of using fraudulent means. This refers to the practice of using fraudulent means to pay lower tax or not to pay any tax at all. This refers to the practice of using fraudulent means to pay lower tax or not to pay any tax at all. Alright. Now, this is a criminal offense and attracts sanctions from the tax authority and or the courts at the same time. So sometimes if you evade the tax, the Commissioner General can say, for the tax you've evaded, your penalty is 50% of the amount, then you pay. Other times, we will process you, we take you to court, and the court will deal with you. And in the court, you may pay 5 times, 2 times, or you pay the money plus go to jail in addition to it, depending on what is happening. You do it. Go to jail. I don't know, maybe you want to go to jail there. So what constitutes tax evasion? What constitutes tax evasion? So let's look at some of the things that constitute tax evasion. Number 1, it includes using 2 receipt books to record transaction. Using 2 receipt books to record transactions. Using 2 receipt books to record transactions. Now by 2 receipt books, you know what we mean. So there is a proper receipt book for accounting purposes, preparation of financial statement so that the profit will be huge. Then there is another receipt book or different set of book for tax purposes. Always, this is going to be what? Lower, so that the tax effect of the company is going to be smaller. That is using 2 different books. 2, failure to declare or under declarations. Failure to declare or under declaration. Failure to declare or under declaration. So you earned an income. You did not report on it. It's an example of tax evasion. Like someone gives you gifts and you're supposed to pay a gift tax, but you don't go to declare about it and pay the tax. It's an evasion. Or you go and say, oh, the gift was $2,000 when the gift was actually $10,000. So in that case, that is what? They should.
Who files it?
So that's the second one. Third, submitting false statements and returns. Submitting false statements and return. Submitting false statements and returns. That could also result or include tax evasion. Submitting false statements and returns. Next one, overstating expenses and costs. Overstating expenses and costs. Overstating expenses and costs. Next one. And any other fraudulent act or means of deliberately dodging, and any other fraudulent act or means of deliberately dodging or minimizing payment of tax on one's income. Deliberately dodging or minimizing. Maybe you have started cursing me because I didn't give you your chocolate. Yeah, right, easy. And then deliberately dodging or minimizing payments of tax on one's income. So these are some of the things that constitute tax evasion. These are some of the things that constitute tax evasion. So when you do any of these things or advise your clients to do any of these, you are supposed to be jailed as the person giving the advice, and you're not supposed to do that. So let's look at the various ways through which businesses can avoid tax legitimately and pay lower tax in that case. So let's start with some tax incentive for various businesses. So tax incentives for various businesses. So what are the various tax incentives available for various businesses? The first one we want to look at is free zones. Free zones. Free zone businesses. Now usually the free zones is simply where companies are located and they produce goods exclusively for exports, right? They produce goods exclusively for exports, or they produce goods exclusively for exports, or about 75% of what they produce is exported. Are you getting it? They produce the goods exclusively for exports, or about 75% of whatever they produce is exported. If you meet this criteria, then there are tax benefits available for such organizations. So what are these tax benefits? Let's list some of them. You good? Okay, 1. Companies will be exempt from value-added tax and import duties. Companies will be exempted from value-added tax and import duties. Companies will be exempted from value-added tax and import duties on imports of raw materials and equipment. On imports of raw materials and equipment for use in its business operation. For use in its business operation. So the first benefit is the exemption from VAT and import duties on raw materials imported. So that's the first thing. So the raw materials they import, they don't pay VAT or any import duties too. Exempt from payment of corporate tax for the first 10 years of its operation. Exempt from payment of corporate tax for the first 10 years of its operation. We will continue. For the first 10 years of its operation. For the first 10 years of its operation. However, it's required to pay 1% on assessable income. However, it's required to pay 1% on assessable income. You good? Next one. Dividend paid to shareholders of companies shall be exempted from withholding tax. Dividend paid to shareholders of companies shall be exempted from withholding tax. So you are a shareholder of that, you don't incur withholding tax. Next one. Can obtain permission to sell up to 30% to the domestic market. Can obtain permission to sell up to 30% to the domestic market. But chances are most of these organizations, they sell plenty here. They sell plenty. Because the exploitation, they are going to be incurring costs, but selling it here, boom, it's good for them. But that is a benefit. They can obtain that permission to sell 30%. How many points do I have? How many? 4. Okay, so let's take the next one. Faulty goods which fall short of meeting international market standard. Faulty goods which fall short of meeting international market standards. Faulty goods which fall short of meeting international market standards shall form part of the 30% for the domestic market. Shall form part of the 30% for the domestic market. So if the product doesn't meet international standard, then that will be part of the 30% they would want to sell to the domestic market. The last one there. Export of goods and services shall be taxed as 15%. Export of goods and services shall be taxed at 15%. Export of goods and services shall be taxed at 15%. As opposed to 25% to domestic market. As opposed to 25% to domestic market.
It's still the same.
Yeah.
Not opposed to
25% to the domestic market. So what will motivate you to sell it outside is that you'll be paying what? Less in the duty cost of it. So that is it for free zones. There are other points that we could add. I'll be sending an ebook out that you can download as well on the course, and you will get more of these things. Next one is farming and agro-processing businesses. Farming and agro-processing businesses. Farming and agro-processing businesses. I think this one, the list is quite tall. Maybe what I have to do is to send you the document, and then we go through it. Because it's not a way I can summarize some of these things. So for farming, so I presented it in a table. So farming on one side, agro-processing on the other side. So under farming, oh, you already have that?
No.
You already have that?
No.
But you're flipping through things, nigga.
No, I'm just putting it down.
Nigga. Alright, so under farming, the tax holidays ranges from the following. 1. For tree crops, we have 10 years what? Tax holidays, starting from the first day of harvest. I see you having that.
Gone for 1%.
What?
1%.
Yes, all of these things now come with a 1% deduction.
So,
What? Cattle, also 10 years. Livestock, fish, cash, from what? Cash crop, that is 5-year tax holiday. Then income from cocoa farmers, this one is indefinite because they are being motivated to farm cocoa. So maybe one of the things you can do is go and farm cocoa so that you get free tax on that. Then other incentives include Carryover of what? Losses 5 years following the year in which the loss was what? Incurred. Then employees residing on farm, their rent element is excluded from the determination of their income for tax purposes. So the employees on the farm, their rent element, you know, that is a bonus that we would have included, but that will be excluded in the determination of their tax issues. You have that already there?
No.
How come? Oh, but I thought you said you had it already.
No.
Jeez.
No, on the farming and those ones.
So which one do you want?
So you are seeing exempt from what was.
Okay, so that one. So employees residing on farm, employees residing on farm, their rent element is excluded from the determination of their income for tax purposes. Employees residing on farm, their rent element is excluded from the determination of their income for tax purposes. For tax purposes.
Determination of value.
Of their income for tax purposes. Right, so carry forward of the loss. Carry over of loss 5 years following the year in which the loss was incurred. Carry over of loss 5 years following the year in which the loss was incurred. Following the year in which the loss was incurred. You good? Now, for the purpose of our discussion, when we say farming business, this means the business of producing crops, fish, and livestock. So any business that involves producing crops, fish, and livestock, that is what we mean by farming business. Then when we say tree crops, we are referring to coconut, coffee, oil palm, rubber, and shea nuts. Very important. Coconut, coffee, oil palm, rubber, and shea nuts. These are what we describe as tree crops.
Maybe they're producing what? Fish, crops.
And livestock. You good? Then cash crops include things such as cassava, maize, pineapple, rice, and yam. These are some examples of that. So that is it about the farming aspect. Agro-processing. Agro-processing at this level means converting crops, fish, or livestock produced in Ghana into edible, canned, or other packed products. So converting crops, fish, livestock produced in Ghana into edible, canned, or other packaged products other than their raw state. Other than their raw state. Other than their raw state. Is that what? Edible, what? Can or other packaged, produced in Ghana, or other package, produced in Ghana, other than their raw state. Other than their raw state. So with agro-processing, what are some of the things that we have there? So let's see some of the things that we have on agro-processing. The usual thing is 5 years of assessment income from the commencement. They are exempted from it. 5 years generally. But in addition to that, let's look at some of the things. Agro-processing business before 2004 have a 3-year tax holidays. Agro-processing business established after 2004 have what? A 5-year. So the general rule is that for agro-processing, 5-year tax break that they have, for them to chill out, for them to have fun in relation to that. Then let's...
2004.
Yeah.
3 years.
Yes. You're good? Now, in addition to this also, there are other forms of businesses that enjoyed some tax or holidays that we need to look at. The first one is, so this is also in a tabular form, the first one is real estate. Real estate. From the start of operation, real estate businesses enjoy 5-year tax holidays. So they don't pay tax, but they will pay 1% on their chargeable income. You already have that as well? Rural banks, 10 years tax holidays, but they enjoy what? 1%, or they have to pay 1% of their chargeable income. Then we also have fish farming, poultry and cash crop, 5 years, they pay 1%. Free zones enterprises.
Is it during the first 5 years that you pay the 1%?
Yes, during the first 5 years. Then there are other tax incentive which is based on your location. Your location. So what are the tax incentives based on your location? Number one, manufacturing industries located in Accra and Tema are going to pay tax of 25%. So if you're a manufacturing company and you're located in Accra and Tema, tax rate is 25%. All other regional capitals, 18.75%. So Accra and Tema, 25%. All other regional capitals, 18.75%. Now, why are these figures important? Because when you are now calculating the tax liability of a company, you must consider which sector it is in and where it is what? Located. Very important. Then, located outside regional capitals, they pay 12.5%. Located outside regional capital, they pay 12.5%. So Accra and Tema, 25%, because you are having access to everything. Regional capitals, we want to motivate you, so you go for 18.75%. But for the people outside the regional capital, we want to further motivate you, so you pay only 12.5% in relation to that. Then, so that is the first aspect. Then the second aspect is this. After the initial 5-year tax period, agro-processing enterprises, which use local agriculture raw material as their main input, shall pay the following taxes. So listen carefully. After the tax holidays, okay? After the 5 years.
So the manufacturing is this after the 5 years? And then there's annex.
Yes, the manufacturing it remains like that. So for agro-processing enterprises, after the initial 5 years of the tax holidays, they will now pay the following taxes based on their location. They will now pay the following taxes based on their location. Tema and Accra. So Accra and Tema, you're going to pay 20% from there after that. other regional capital with the exception of Upper East, Upper West, those things. So other regional capital. Now the regions are more. So as at the time we are preparing this, we've not factored in the new region. So we will
Which
keep.
new region?
You don't know, Ghana now we have 16 regions. So
16, I know 10.
16 regions.
I know 10.
We are Ahafo North, Ahafo South, Voter North, Voter South, Kennedy. Now, just who be Ghana? You don't read news. We now have like 16 regions.
I see it as an act of me.
So your mind is just I see. So other regional capital except North, Upper East and Upper West. So this is excluding Northern region, Upper East and Upper West. So excluding these regions, all regional capitals we go for 15%. That's what you're going to pay. Then for the northern region and all other locations, so now these guys, they are excluded from here. So now we want people to go to the northern region, okay, to the Upper East and then the Upper West. So Upper East and Upper West, as well as all other locations and all other locations, we're going to go for 5%. What a wow. What a wow. We're going to go for 5%. Please note that what we just discussed is actually from the Ghana Investment Promotion Center, GIPC. It's a data that is available on the public or for the public, and that is the data we are using in order to gather this tax incentive for various businesses based on the rate and based on their location. Any question, please? You good? Hypocrisy. Now, point of note. When calculating the chargeable income and tax liability of a company, remember to take into consideration the location and the industry of the entity. Very important. When calculating the the chargeable income and tax liability of a company, remember, when calculating the chargeable income, and tax liability of a company, remember to take into consideration the location and industry of the entity. The location and industry of the entity. The location and industry of the entity. So off the bat, I want you to know three things. Number one, that all these companies we listed enjoy 10 5 years tax break. During that time, they are not supposed to pay the normal tax that each company would have paid. But then, they will pay 1% on their chargeable income as their tax liability. Number two, that the tax computation of an entity depends on the sector or industry it is in and even where it is located. So, how is this question going to be set? It's going to be set in two ways. One is where financial information will be provided to you and you are calculating the chargeable income and then the tax liability for the company, taking into consideration the sector it is in and also the the location that it is at as a company. Then also another way the question can be put, since this level is more advisory level, is where the examiner is going to ask you that a company from China want to invest in Ghana. And so they want to invest in Ghana, they are contemplating which industry they should what, go into. So in such a case, you have to look at the marks and find out the volume of things you're going to be what, writing. So you're going to give them the advantages and disadvantages of various industry or various locations that they go into. So if somebody decides to go to Accra, what are the benefits? You get access to the resources, you get access to electricity, you get access to qualified staffs, and everything will move well. If you go to the regional capitals, what is going to happen there? It's not all the regional capitals that are well developed, that are well equipped. So you are giving the advice on the tax benefits, but at the same time, ensuring that the business will operate successfully in where it is going to be what? Situated. So these are the things that you're going to be looking at. Calculation aspects and writing an advisory report to the entity. Yeah, but you know it has been separated as it has its own. You know, we have Metropolitan Assembly. It's a whole metropolis on its own. That is why we separated from Accra, even though it's part of Accra. Or you think we should say, people are actually agitating or arguing that it should be a whole region on its own. So that is the idea about the various incentives available for businesses. So when these are available, these are called benefits. So these benefits now, the company will now use them to their what? Advantage. Now, any company located in any of these areas and still engage in some of the things we listed is what? Evading tax and will be prosecuted or taken on by the Commissioner General. So that is the idea, and that is what you have to understand about that. So let's look at the various ways through which companies can plan tax in relation to that. Let's look at the various ways through which they can do that. Now remember that what we're talking about, you don't have that, I bet you don't have that. I say you don't have it, so don't even dare it, because you don't have it.
What I'm looking for.
Nigga, you don't have it. She ain't got it. She ain't got it. So approaches to tax planning. Approaches to tax planning. So in addition to the various benefits available, these are the loopholes that people can use or entities can use in planning their tax. And I think I should take that in the next video, right?